Bill. Okay, so anyway, our power hour today is Thursday, July 15th. We're already halfway through the year and we're just starting a couple minutes late, but I so appreciate everybody joining Half Hour Power Hour. This has actually been a platform designed for you, the viewers, since we started COVID last year. And COVID what actually at this point, which is good news. Anyway, I just want to if you guys want to follow me on Facebook, Instagram, join the Half Hour Power Hour group to see anything that you may have missed in the past, please do. This is actually just an extension to keep you guys informed of what's going out there in the real estate market, because as you know, it's a hot market, but also to allow you the opportunity to see what's going on in our community with everything reopening, concerts, finally that we can get tickets to, restaurants, some outdoor living. And if you know of anybody that you would like to see as a guest, please keep me in mind and let me know, because I'm willing to take any feedback and just want to provide information to you. Sorry, you guys, for some reason I feel like I'm just kind of scrambling right now. So I apologize, because this is what happens on when you are live. And thank you so much for joining our summer series. I am super happy to have back Bill Angove with Asset Preservation. Bill, thank you and welcome to Half Hour Power Hour again.
Thank you for having me. I appreciate you inviting me back.
So Bill is actually going to be talking about 1031 exchanges. A lot of people out there don't even know what a 1031 exchange is. And Bill has been working with 1031 exchanges, I think now for what, 23, 25 years?
Feels like forever, but 23 years, yeah.
Yeah. Bill lives here, has a family here, but I do know one of his personal hotspot favorites is not necessarily Placer County, but it's more like San Diego. But we're glad that you're here with us today, Bill, right here in our area.
Appreciate it. Thank you.
So basically what we're going to talk about today, and I've noticed a lot of people that I'm even listing their homes, they will get an offer that's a 1031 exchange offer. So those of you who are out there who don't know what a 1031 exchange is, please stay tuned. We're going to talk about that. Those of you who have an investment property, you should absolutely know what a 1031 exchange is. And then we're also going to dig deep into when people are selling and doing a 1031 exchange in today's hot sellers market, where are they going? And then what is kind of the talk on the street for what maybe Biden might be doing to the investors for 1031 exchanges?
Looks like we got a lot on our agenda.
Yes, we do, in a short amount of time. And you know this stuff inside and out. So if you have any questions, please feel free to put it in the comment section on Facebook. And then my assistant, Michelle, she will text them to me and we will definitely discuss with Bill. But we may even have a lot of these questions answered. So Bill, I'm going to turn it over to you, just kind of in layman's terms, if you can talk about what is a 1031 exchange.
Sure, glad to. This is Internal Revenue Code Section 1031, Jill. It's been on the books in Internal Revenue Code since 1921. We're actually celebrating 100 years of doing exchanges. Now, they've gone through a number of different changes over the years, but we had the final regulations coming out on how we do them today in 1991, not that long ago. But basically, it's this. Anytime that someone is selling a piece of investment property, whether it be a rental house, an office building, land, you name it, anything that's not their primary residence, Section Code 1031 allows them to sell that property, defer their taxes, both state and federal, and buy new investment property anywhere in the United States. So when you're looking at the taxes, if you're selling a piece of investment property, especially if you've owned it for a long period of time, you're looking at currently either 15 or 20% tax capital gains to the feds. Plus, if you have a property you've taken depreciation on, that depreciation is taxed first at 25%. And then in California, if you're selling a property in California, has a sliding scale between 0 and 13.3%. So as an example that I give on a regular basis, let's say somebody bought a property for $4,000 and now it's worth $1 million. Well, they go, okay, my gain $600,000, right? That difference. Well, no, because they've taken depreciation all these years and their basis for tax is really only 100,000. So that takes their gain to $900,000. And so all the depreciation is going to be taxed first 25%. And then the other balance of the 900 or 600,000 is going to be taxed at either 15 or 20%. And then there's what's called the net investment tax, which is due to Obamacare, tax on another 3.8%. And then California probably tax on another 13.3%. So this person, they bought it for 4, they're selling for $1 million. They're probably going to pay over $350,000 in tax, state and federal.
Oh my gosh. Okay, there's a lot of little tax consequence. I didn't even know the Obamacare piece was in that for additional
It's called
tax.
the net investment tax, 3.8%. Yep.
Holy cow. Okay.
Yeah. So what does an exchange allows you to sell deferred? You don't eliminate those taxes. It allows you to defer paying those taxes and buy a new investment property anywhere in the United States. As you know, Jill, there's a lot of people that are exchanging out of California. So where are they going? Idaho, Texas, Florida, Tennessee. Eagle, Idaho seems to be the new Granite Bay of Idaho. Evidently, a lot of Californians are moving there. I even know some agents that they've already moved there and they're doing exchanges out of their property, say in Elk Grove, and they're buying rentals in Idaho because California people are coming there fast and they need to find some place to live, whether looking for their primary residence or they want to do an exchange. So it's a great tool. It's been around for a long period of time. Our company's been doing this for over 30 years nationwide. We're one of the largest qualified intermediaries in the United States.
So, okay, so you're saying deferred, so that means that it's not necessarily that they're escaping the taxes, they're deferring it through a 1031 exchange. So if we take that same example of that $400,000 home, it's worth 900, somebody goes to sell it, but then they're going to do a 1031 exchange, let's say in Idaho.
Mm-hmm.
And then let's say they sell it in a few years. Are they then taxed based on Idaho or the California first side of it?
Both.
Oh!
So let's do it. This is what's called the exchange equation. The exchange equation is basically, if you don't want to pay any taxes, you want to buy of equal or greater value when you're buying a replacement property. Now that gets adjusted by a couple of things. Number one, you want to take closing costs and commissions off the top. So let's say I'm selling for $1 million and I incur $50,000 of closing costs and commissions. So what I really need to go buy for is $950 in the exchange. Okay. Now, when you exchange out of California, California has a clawback law. It says, we don't forget, if you exchange to Idaho and you've deferred $300,000 in tax to California, California requires you to continue to file the California informational return that you own that asset in Idaho every year. So eventually, if you do sell Idaho, Jill, California wants its tax on that $300,000 of gain that you deferred 5 or 10 years ago when you did an exchange.
Okay.
Plus, now Idaho, if they have a state tax, I can't recall off the top of my head. I know Nevada doesn't, I know Texas doesn't, but any gain that you have while you own the asset in that state, wherever it is, then you're going to pay taxes to that state also, over and above what you paid for it. So,
but if you leave California, okay, let's say you're gonna owe that money no matter what. It's gonna be it's just deferred. Though you might be able to buy 2 properties in Idaho, now have 2 rental incomes. And is that why people are doing that?
well, not only that, the boomers are retiring and they're starting to think about, well, do I want to stay in the Bay Area? Do I want to stay in Roseville or wherever? I may have kids in Colorado. I may have family in Idaho. So they can sell that one larger asset and go buy 1, 2, 3, or 5 properties. Maybe they want a vacation home in Hawaii. Great, they can buy Hawaii. They can't move into it and use it strictly as a second home right away, but they rent it out for a few years. And then after a couple of years goes by, they can do whatever they want. So you think about the people that are flocking to the Palm Springs and Palm Desert during the winter months, and then they come back to Idaho for the summer, right? When the weather's nicer, warmer, not freezing 15 degrees. And so they can do that. Or they want to buy close to where their grandkids are or their kids are, right? They can do that. A lot of what we're seeing actually is a lot of people consolidating. They're tired of what I like to say are the T's: tenants, toilets, termites, trash, and taxes.
Ooh.
Right? A lot of the boomers, they are taking care of manage their own properties, and they're saying, I'm tired of this. I don't want to call to fix the plumbing. So they'll sell 2-3 rental houses at a time and go buy one larger property. And they can do that. That's the flexibility and the diversification of an exchange. You can increase your cash flow, defer the taxes. Now, I like to say swap, pay a drop. If you never want to pay taxes, keep exchanging throughout your life. And then when you pass away, currently your heirs would inherit up to $11 million per parent. We'll see how that changes with Biden's plan. He is saying that you would only get to get a step up in basis to $1 million. So we'll see if that goes through.
So let's touch base on that then. So to the heirs, let's say it was worth, or you're okay. So to the heirs, then they get it. Then if they sell it, do they have to pay the deferred taxes?
Well, currently that's this year, right now, before any Biden plan, the heirs get to inherit the property at a step up in basis. So mom and dad paid $100,000 for the property. Now it's worth $1 million. The kids will get it at the $1 million value. So there's no taxes due. All right. But if they own the property for, 3, 4, 5 years down the road and it appreciates in value, call it to $1.5 million or $2 million, then there's your gain, right? The difference between what they inherited that upon death and what it's worth today. There's their capital gain. So yeah, they may need to do an exchange. The important thing to note there is when the kids inherit the property, they want to make sure that the property is in each kid's name, because if it's still in an irrevocable trust, the irrevocable trust is the entity that owns the asset, not the 3 kids. And so the 3 kids can't go their separate ways. So planning and talking to a CPA or a tax attorney, planning ahead when you sell an asset of any type is always good to get some good advice on that.
Wow. Okay. That's like a whole other half-hour power hour.
Yeah, you need to have a CPA as a guest, not me.
Yeah. Oh, because that could just get so, crazy. Okay. So let's say somebody owns 3 here.
Mhm.
They're like, you know what? We just want to get rid of them. All those T's that you described, they're done.
Mhm.
So
Mhm.
they just want one property. And let's say all 3 of those properties, do they have to sell them all at the same time and buy that one? Like, I know there's restrictions with the 1031 exchange. So let's talk about maybe that part of it and then go to my question.
So let's talk a little bit about timing. First of all,
Okay.
whether you're selling 1 or 3, when the first property closes, that begins the exchange process. Now, word to the wise, if your client is planning on doing an exchange deal, they need to set up the exchange with a qualified intermediary, us, about 2 weeks before close of escrow, because if they close escrow and call us after the fact, they have a taxable event. So what we need to do is prepare the documentation for their exchange. As you know, when we worked in the past, we want to educate your client about the timing, the process, the identification. So when they close, the proceeds from the sale are wired to our company to be held during the exchange process. From that closing date, they have 45 days to identify in writing what it is they're going to buy. And from that same closing date, they have 180 days to close on that replacement property or properties. Now, if they're selling 3, when the first one closes, that clock begins to tick. So they want to try to get the other 2 closed as quickly as possible, if not on the same day as the first one. So you know what kind of numbers you're going to be working with if you're consolidating all the cash from the 3 sales into one big purchase. But if you can't, you got 3 separate buyers, you've got 3 separate closings.
Wow.
You may want to, what I build in contingencies or extensions, that's what you do, Jill, is to protect the client so they can try to get them all close together as possible.
Okay, so 2 big things right here is you need to get with Bill Angove ASAP if this is something in your head that you're thinking of doing, because the last thing they want to do is contact you after close escrow. And then B is get with a really good realtor too that can help manage and put a realistic plan together, because time is of the essence, especially when that first one closes, if there's going to be multiple.
Absolutely. We have a ton of information on our website, including a webinar. If people want to go back and watch that. Can I give our website right now? I know Michelle may have already put it up.
Yes.
So it's A as in Apple, P as in Paul, I as in Indiana, exchange. So APIexchange.com. And my email is just bill@apiexchange.com. Phone number 832-1031. Had it for 23 years, 916.
It's very
Thank you.
creative. No, thank you, Bill. So that webinar, we can just go and take a look at that. And
Yeah, we have
it'll,
a YouTube. It's on. So we have the YouTube and the Twitter and the Facebook symbol all on our website. And they
okay.
just click on the YouTube symbol and it'll take you right to all the different webinars we have there too.
Okay, that will be good for me to definitely take a look at too. Okay, so just to go back, let's say you're going to sell 3 of them as an example. Let's say they are 1.5 million. The day the first one closes, you have 45 days to
Identify.
property that you want to purchase, and there has to be 3 or.
Well, there's 3 different options. The first option you mentioned is the 3 property rule. So you can identify A, B, and C, and you can buy A, B, and C, or all 3 together. That's the most flexible rule. The second option is the 200% rule, and that says if you list 4 or more properties, then the value of all of them combined cannot be more than twice the value of the property you're selling. So in your example, selling for 1.5 million, right? If you go out and find me 5 properties to list, Jill, then that says all 5 of them combined can't be more than $3 million. Okay, so it's double if you list more than 3.
Okay. Okay.
And the last option, the 95% rule, says if you list more than 3 and their values do exceed double what you're selling for, then you must acquire 95% of that list. So in your example, selling for 1.5, you list 5 properties worth $4 million. You've got to buy all of them under that rule. So most people use the 3 property rule.
Okay, okay. And really then, you can't buy for less, otherwise you can get taxed. You got to buy for at least $1 more, right?
Generally speaking, you want to buy an equal or greater that we talked about. The real exchange equation is if you don't want to pay any taxes, you do 2 things. Number 1, you reinvest all of the cash proceeds that come out of the sale. Number 2, take on a loan that's the same or greater as your old loan. So if you've got an outstanding loan balance of $250, you should have a new loan of $250 or greater in the replacement property, but you can offset that loan with cash. So you dig into your piggy bank to the tune of $250,000 and you put that as an additional down payment with the other proceeds. You don't have to have a new loan in the replacement property if you offset it.
Okay, okay. And again, you guys, if you have any questions, feel free to put it in the in Facebook comments and we'll get those answered. And so it's because, and a lot of people think it can only be cash, but really no, it doesn't have to be. You can still get a loan on top of that.
Yeah, absolutely.
So, Bill, what are you seeing investors doing here? Are they selling here and staying here, or are they all selling and going elsewhere?
We're seeing it all, Jill. We see people looking at what's called the Delaware Statutory Trust investments like a REIT. It's not a REIT. We see a lot of people exchanging out of California, as I mentioned. We see a lot of people coming from the Bay Area and buying rentals here and properties in Tahoe. Because the boomers don't have to live and work in San Francisco or San Jose anymore. They can work everywhere. And so we're doing a number of exchanges in Tahoe, Truckee, Greenwood, LaHunt, and those types of marketplaces. A ton of people in South Lake Tahoe are doing exchanges, getting out of South Lake because they enacted Measure P, which is the, and I can't explain it perfectly, but it's limiting the short-term rentals that you can have in a certain part of the strip on Highway 50. So you have the people that live there full time, and the house next door is a rental or Airbnb, and you get the bachelor or bachelorette party coming in, party till 6 a.m. So those people up there said, we don't want any more of that. So they place limitations. So people are selling the rentals and going other places.
And then like when you brought up, let's say Hawaii or even Florida, let's say somebody sells a few of they live here, they sell a few of their properties, they find something in Hawaii.
Mm-hmm.
And it goes through they follow all the rules and everything. How long do they have to rent that out before they say they want to have that house as their primary residence? And what does that financially look like?
2 answers to that. There was a court case not long ago regarding vacation/second homes. Person did an exchange on a second home strictly for another second home, which means for your audience, it's strictly for personal use, no rental income whatsoever. The IRS audited, they took it to the tax courts and fought it, and the tax court finally said, no, that doesn't qualify. So if you buy a property in Hawaii and you tend to use it only for personal use, that does not qualify. So they
Okay.
said, if you're going to buy a vacation second home for the first 2 years that you own it, the personal use can only be 2 weeks each of those 2 years, or 10% of its annual rental. So if you rent it out 300 days, then you get to use it 30 days, right? They
Okay.
also say you have to rent it out for at least 2 weeks or more each of the 2 years after you acquire it. Okay. But now the second part of your question is, how long do I need to hold a property for before I do my next exchange or move into it? And their answer is there is no set answer from the IRS. Some tax advisors say hold the property a minimum of a year, or straddling 2 tax years, or hold it for 2 years or more. The intent of the code is that the property needs to be held for investment, not flipped. So they leave it wide open, because there have been court cases where people held it less than a year, but they won because they had the intent to hold it for a long period of time. And then there's other court cases where they held it longer than 10 years, but the IRS disallowed the exchange for various reasons.
Okay, so when I've heard people say that they want to sell their investment property here, buy something in Florida or Hawaii, and that they're going to move there in a couple of years and make
Mhm.
that their primary residence, they're doing a 1031 exchange, buying their house in Hawaii, they're
Mhm.
renting it a couple of years, then they stop renting it, they move and sell their house here,
Mhm.
and then they make that their primary residence. As of today, because laws can change, they will just have to pay the deferred taxes that they were deferred.
Right. There's a couple rules that came about. One in 2014, they said if you do an exchange from property A to property B and you eventually move into it, you cannot take the primary residence exclusion until you've owned the property for 5 years. So what people were doing before that is they'd move into the rental, live there for just 2 years, right? Then they could take the $250,000 or $500,000 in gain out under Section Code 121, which only live 2 years out of 5, you can take 500 grand. Well, in 2008, they instituted another rule, said, okay, you've had this rental for 6 years after 2009, or last 6 years, all right? And you've rented it 4 out of those 6 years, and you move into it for 2. But now you've got 2 years of rental and 4 years, 2 years of primary and 4 years of rental. Well, under that scenario these days, they may not get the full 250 or 500,000 exclusion. If they're single, they may only get $100,000 of gain out because they've lived there 2 out of the 6-year period. So they look at that ratio and say, nope, you got to live there longer. You may have to live there as long as 5 years to be entitled for the 250 if you're single, or 500 married, filing jointly. So the rules change, but a lot of people think they can just go move into the rentals for 2 years and pocket all the money, and that's not the case anymore.
And that's not going to happen, right? No, no, no. If it sounds too good to be true, it is.
Right.
So, okay, so then, and before I do want to touch base a little bit too about, well, first of all, this can be very confusing to people, and it's a big financial decision. So I think getting with you, having those conversations before anybody makes a move, because every situation is different, it could be.
Right.
And what their goals are. So I think getting with you is super important. And again, those of you who are watching, Bill's information is right there listed on Facebook Live. So let's talk about, what is Biden wanting to do? And the talk was he was going to do that. Is it going to happen? But let's talk about what his plan is or was.
Well, first of all, everything that's out there, there's a lot of misinformation out there. The first misinformation is 1031s are going away completely. That's not true. Biden came out with his proposal about a couple months ago, saying, number one, he wanted to raise income tax rates on the rich. He wants to raise capital gains tax rates to 28%. If you're rich, make over $1 million, say when you sell an asset or have dividends over $1 million, they're going to charge you not a capital gains tax rate, but 39.6. But the one that came out that affected our industry is in this proposal was that they want to take 1031s away from the top 1% people. People had huge amount of gains. So what they're saying in the proposal is that if you're single, you would only be able to protect $500,000 of gain in an exchange. So for the people in the Midwest that have a rental house that made only $150,000 on this property, they've owned it for 10 years, it doesn't impact them. But think about us on the West Coast. Do we have gain clients? You probably have lots of clients that have gains in excess of $500,000 on their property. Right. Now they're only going to be able to protect 500 grand if they're single, or $1 million if they're married and filing jointly. So This is really going to impact the commercial real estate world because those clients that have multi-million-dollar apartment complexes, office buildings, huge amount of gains, they're going to sit on their thumbs and say, "I'm waiting. I'm not going to do a thing." So it's really going to impact the commercial real estate industry and those of us on the West Coast and East Coast that have gains in excess of those two numbers. So what are we doing as an industry? The National Association of Realtors is lobbying against it. Anybody who touches a deal, whether it be the real estate community, CPAs, attorneys, title escrow, you name it, are lobbying Congress very strong. What's the next step? The next step is sooner or later a bill is going to come out of the House, and then sooner or later a bill is going to come out of the Senate. Will it or will not contain this language proposing the changes to 1031? We don't know yet. There's a lot of behind the door negotiations going on. They say a bill could come out of the House as soon as in the next couple of weeks. If not, they've got their August break, so it will maybe not come out until September, and then maybe in the Senate that same month or a month after that. So if it goes as they want or as they have proposed, more than likely these changes would start to be impacting us in 2022, beginning of 2022. Some people have said, "Oh, it may be retroactive to the beginning of 2021." I think a lot of Congress people would lose their jobs and get voted out of office if they made it retroactive.
Oh, that would be terrible. So,
Yes.
and they would probably be part of it because I'm sure they own investment properties too. And
Well, that's
apartment
why this is divided. It's not a clear case because there are a lot of Democrats that own real estate out there too, as well as Republicans, and they have those farmer clients in the middle of America or Central Valley here in California, where the property has been owned in this family for generations, right? And the matriarch and patriarch still own it. Their basis is $1,000 an acre, and now it's worth $100,000 an acre, and they sell. They're going to pay a lot of money in taxes and not going to be very happy with their congressperson if this goes through.
Okay, so we might see something soon, but it would hopefully, we never know anything these days.
Right.
But hopefully we'll see it next year, but that it's minimal, if anything.
It's gonna, the big thing is taking capital gains taxes back up to 28%. They were back there years ago. That'll be a big one. The increase in capital gains, if you had income over $1 million to 39.6, will definitely slow real estate sales down. It's going to have a huge impact on anybody that touches a deal because, as you know, selling just primary residences, think about all the people that touch a deal, and the inspectors, the lenders, and everybody that's title and escrow. And so if the real estate market slows down because of this, and whether it be residential or commercial, there's a lot more rental houses in the states these days than there are $100 million office buildings. So a majority of exchanges are those 1 to 10 units.
So, okay, so what do you, so can you hear that in the background?
Yes, I don't know what that is.
Oh my God, I have my son on when he's on special. So he's like Stewie on, when he messages me, it's like Stewie's voice. So he's like the only one that gets through on my phone when I have it on silence. Okay, so what was I going to ask you? There's one other thing before we wrap up, and it was about, okay, what we're going to see possibly next year. Oh, this is what I wanted to ask you, Bill. Because it's a seller's market, and I mean, it's crazy, which I can see on my end, and you're seeing where people are going. Is your sales, I mean, has it increased your transactions?
We are up over 40% month over month from a year ago. I mean, for the last 5-6 months, Jill, our new open orders are up over 40%. And so we are working. That's why we need that 5 days before close of escrow to set up the exchange, because we used to be able to say, hey, you're closing tomorrow, Friday, we can get it done today. We can't because our staff is just too overworked right now. And we don't want to lose people. I mean, if people overwork, they're going to go somewhere else or not work at all because it's not physically and mentally healthy, right? And so you've got to have balance in your life. So we're basically very busy. It's a good problem to have. We're actually doing a ton of reverse exchanges, and that's something to throw out to your clients every now and then. The reverse exchange allows the client to buy the replacement property first with the qualified intermediary, and then they have 180 days to sell their old property and exchange into the one that we're holding for them. I've done 4 reverse exchanges in just the trucking market alone in the last month.
Oh my gosh.
Yes.
Okay.
Because
Wow.
people
Okay.
have to buy first. That's, you know how crazy it is up there.
Right. And a lot of people are even saying, a lot of people are even saying that people are even asking, well, why would I buy an investment property when it's a seller's market? And there's just so many, it's all a personal decision and what their goals are. And I did, and I know my friends have as well this year too. So I think if your realtors are doing something like that, that says a lot as well, because we're in it every day. And, but it's kind of crazy to think how, because if your world is rocking, our world is rocking too. And I just think there's so much information. And so that's why whether somebody is thinking about buying an investment property, even though if they're not exchanging, I also think it's a good conversation, have with your realtor, but also somebody like you to see what does this look like for me in the possible future. And then I do have investment properties. I'm thinking of selling one, maybe 2. What do I do? Can they come to you for that kind of consultation?
We can't do their taxes, but we can talk to them about the exchange process. And I encourage people to reach out either on our website or to me directly saying, hey, I'm thinking about selling a property. Here's what it's worth. Here's what I owe on it. Here's what I paid for it. You know, if I sell it, what can I go buy? Where can I go buy? And that's what I'm here to do, is educate you and educate your clients about the process. Even if they're thinking about putting the property on the market, then we can make a decision with them and walk them through the process. But I can't say your taxes are going to be $350,000. That we're not allowed to give tax or legal advice as a qualified.
Okay, me neither.
But they sure like to ask.
I know. And I really wish I had the answer, but I don't.
Right.
Because it's different for everybody. So Bill, and before we conclude, anything that you'd like to add that we didn't discuss?
Well, the big thing I want to point out to your viewers is, believe it or not, our industry is unregulated. And at any given time, our company is holding between $2 and $3 billion of people's money nationwide. So if you're going to be contemplating doing an exchange, make sure you're looking at a qualified intermediary that has some kind of parent company or some kind of financial backing that says, if you've got a rogue employee that wires funds out and we have those built-in security devices, that can't happen. But there's a parent company that backs a performance. We're owned by a national title company. That company's been around for 130 years, traded on the New York Stock Exchange. Our company's been doing this for over 30 years. That's correct.
Stewart Title. Okay, yeah.
Stewart Title's our parent company, right? And so they back our performance. So there are other companies that will do it less expensive than we can, but they can't provide those securities of your funds.
Oh yeah, I wouldn't even risk it. If anything about a 1031 exchange, I'm like Bill Angove, period, end of story, your company, because that's a big piece of it. Imagine doing a 1031 exchange and there's no money.
I've had people walk into our office and say, I talked to you on the phone, but I want to meet the people that I'm entrusting $2.5 million with. So they can walk into our office and meet us and shake the hand and say, okay, I've met you, because there are certain cultures out there, they won't do business with you unless they need to.
Yeah, no, I get it. Yeah.
And we're local as it can get. I mean, right here in Roseville, but we are one of the largest in the country.
So Bill, thank you so much for taking your time. And I'm probably going to want you on again.
Of course, I'd be glad to anytime, Jill.
So if you guys need information on 1031 exchanges, please feel free to reach out to Bill. Take a look at the webinars that's going to be on the website that's listed right here on Facebook Live. I'm actually going to be doing the same. And maybe I need to do a 1031 exchange to San Diego, Bill. That's like one of our favorite places. So anyway, you guys, thank you. I know we ran a little bit longer and I so appreciate your support. And again, if you know of anybody that you'd like to see a guest on, please let me know. And today is July 15th, 2021. We're just ending Thursday's half-hour power hour. We are in our summer series. If you want, you can follow me on Instagram, Facebook, YouTube. We are also putting all of the past videos on YouTube. And I just appreciate you guys and your support. And Bill, again, thank you so much for your wealth of information and coming on again.
My pleasure. Thanks for having me, Jill.
Okay, I will see you later and have a great weekend. Be safe. Bye.